Jason, let me kick it to you. We were talking about this recently. And again, the Canadian and US markets are a bit different. I think we don't have quite the same type of earned wage access tools just yet in Canada, but you have in a prior role a leading Canadian fintech worked in the lending department. And so you have very kind of front row seat experience to this idea of balancing customer protection on the one hand and innovation on the other in a regulatorily ambiguous context. I wonder if you can share some of that experience with us.
Of course. And you're right. The actual phrase earned wage access hasn't been used widely in Canada, but I think it's coming from the same principle, which is responsible lending that we share in many jurisdictions. And this is a concept that might, for the prime and higher income population, might just be a concept. And by default, when you pull up the credit of a loan applicant, then probably the debt service ratio is not an issue. But it's a very important and particularly important issue for the underbanked, subprime, or low income population. So in a way, the protection of this particular segment and making sure that the lenders abide by the responsible lending concept has stimulated innovation in a way. So let me give you an example. For a prime applicant, recall the last time you applied for a credit card on the internet. It's asking for your personal information and asking for your consent to pull your credit. Of course, that's a must. And then it's asking some basic information about your annual income, maybe your housing status. Do you own or do you rent? If you own, what's your monthly mortgage amount? If you rent, what's your monthly rent? And that's probably about it. And you probably won't get a phone call asking you to verify the figure that you put in as your annual income. But it's a very different process for the subprime population, because this is where they could get into a high debt ratio situation. So as a responsible lender, then when we make the decision on the loan, the math needs to be a lot more precise. But then how do you do it in a reasonable time frame? And probably you want a good customer experience, probably as good as the prime segment, that you need to return that decision back to them within 60 seconds. So this is where you use an API to connect to their banking. And of course, that's after they give consent for you to do that. And once the banking transactions from the last 90 days, the data comes in, then you will need to use AI and data science to actually determine what's real wage by looking at a pattern, what's not real wage, but a one-off deposit or transfer in, and any habitual spending that might indicate lack of financial disciplines or addictions, like excessive alcohol consumption or gambling. And again, we're talking about sometimes relying on the machines to make a decision. So humans need to tell the machines to stay clear of a few very strict lines. So for example, you cannot make a loan decision based off of a few protected classes or a few protected statuses, right? So making decisions based off of income, debt service ratio, and credit, and maybe some other things that reflect character is okay. So this is interesting, and I think there are some solution providers in both the United States and Canada that are helping some fintechs to speed up their innovations in this particular space.